Now, this Financial Times piece from yesterday illustrates that global central banks no longer trust storing their physical gold in New York or London, and following the last 3 months of geopolitical uncertainty, they're stepping up repatriating their sovereign assets. It's taken decades, but Gatter's golden enveloping horn has fully encircled a trapped Fed. With gold having overtaken US Treasuries as the top reserve asset, as trust in the dollar-based systems weaken, this shift proves gold is being treated as a strategic sovereign asset, not just a reserve holding. It's this simple. Central banks are moving their gold out of London and New York to reduce geopolitical and access risks. India and France are among the biggest recent repatriators, with France now storing all its gold domestically. Geopolitical risks, we've got sanctions, fears over repatriation access, there's driving them to reduce their reliance on London and New York vaults. All of this means the only central bank still short gold is in big trouble.
Gold is moving from a passive reserve asset into a strategic weapon of trust, ownership, and national security. The bigger message is that central banks no longer want promises stored in distant vaults when geopolitical risk is rising, and sanctions can change access overnight. Andrew Maguire, a veteran metals trader known for his focus on physical gold flows, wholesale liquidity, and paper market distortions, argues that recent price action should be viewed in the context of a larger long-term trend. The emphasis is on central banks repatriating gold from London and New York, because the risk of access has become impossible to ignore. India, France, and other nations bringing sovereign metal home show that trust in the Western vaulting system is weakening. Gold overtaking US Treasuries as a top reserve asset adds weight to that shift. If more central banks continue buying and moving metal domestically, the gold market could shift from daily futures pricing to physical control. That change may force a repricing cycle in which paper supply loses power to sovereign demand, especially if hidden official buying keeps removing available metal from the market, while pushing prices toward a new reserve-based reality if Western custody confidence continues to deteriorate. Now we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The World Gold Council surveyed 64 central banks, and 45% stated they plan to buy more gold in the coming year, funding purchases through domestic accumulation programs. These reports back up what our liquidity providers has been reporting all along, and they continue to report. Missing is liquidity provider estimations of hundreds of tons of unreported central bank monetary gold accumulations. So more than 110 days into what was expected to be a 3-day conflict with Iran, it became clear that the US had significantly miscalculated. So cutting to the quick, the US and the wider West has begun facing unplanned increases in oil and commodity prices. Even though that's backing off a little, it's taken a long time to actually erode. And what it did is add to mounting stagflationary pressures. And this effect is increasingly being reflected in Western-facing gold, which was already beginning to break away from these bearish mechanical correlations before this week's peace deal looks to be getting signed. Now, a bit later, we're going to look at the mammoth side footprints left in the charts that mark the point where unleveraged physical buying overran the deluge of 100-to-1 leverage paper supply into the largest Shanghai spot premiums recorded since November 2008. We'll look at that in a little while. Now, but to finish up on the larger picture, it's now being realized that Iran has military, regional and strategic advantages over the US, including underappreciated missile capabilities alongside very, very strong support from China and Russia. Iran has now perceived to have the upper hand, with the ability to maintain pressure on the US-linked bases, regional infrastructures, and key shipping routes, such as Hormuz, if the peace deal collapses, which likely means the US will do their utmost to ensure the peace deal will not collapse. The US has realized that any further escalations would really push oil, commodities, inflation significantly higher. Sustained energy shocks have already weakened the G7 economies. You can see it already, scrambling. Currencies, capital markets being weakened. It's already created an impossible to ignore bullish for gold stagflationary environment, which will take a long time to exhaust. And flying under the Fed's chart-painted bearish narrative, and we'll look at why it was them in a minute. So under all of this, the global majority has not wavered from its 6,000-year acceptance that accruing safe haven gold into uncertain times is the default position to take, and one that continues to strengthen. Asian physical gold demand offers a really small window, because that's, you can't hide that they've been buying gold. It offers us a little window into the wider scale of global South demand. Now, liquidity advisors assess that the paper to physical imbalance has reached an inflection point that will force the unwind of a very large, impossible to defend short squeeze into rapidly depleting stock of what is 100-to-1 momentum hedges for the Fed to have to short cover into. So really, when the Fed is trying not to add shorts to their already deeply underwater position, what they're using is they're bringing in, allowing, incentivizing the wrong at both ends momentums, we'll label a couple of them in a minute, into taking a short position. Then they need to cover into them, need to cover those hedges at some point. And before Asia does, it takes it all off the market. And the Fed is the only central bank still defending the dollar against gold. And liquidity providers assess that this war-induced tailwind, really, they got, provided them the very last throwback kick at the gold price suppression can. It's been going on a long time. But this time they were met with very, very large, unfactored, competing central bank, sovereign, and global South institutional physical demand. Quite simply, under the smoke and mirrors synthetic action, if you look at any chart and look at the chaos, the Fed has dug an even deeper hole ahead of Trump's renewed call to audit Fort Knox. Now, with COMEX open interest evaporating and institutional flows long ago migrated into physical exchanges, the only solution for the Fed to extricate itself from its insurmountable 60-year rehypothecated abyss is to fold its naked shorthand into a US Treasury gold revaluation event. And following the loss of face Iran war miscalculation, which even if the peace deal sticks, it will take a long time to recover, driving an unfactored debt-fueled bearish environment for stocks and bonds into stagflationary pressures. Not seeing it right now, but it's there. There's never been a better segue for the White House to sanction a US Treasury gold revaluation, one that will very well suit Bassett and the entire Trump administration. Now, this Financial Times piece from yesterday illustrates that global central banks no longer trust storing their physical gold in New York or London, and following the last 3 months of geopolitical uncertainty, they're stepping up repatriating their sovereign assets. It's taken decades, but Gatter's golden enveloping horn has fully encircled a trapped Fed. With gold having overtaken US Treasuries as the top reserve asset, as trust in the dollar-based systems weaken, this shift proves gold is being treated as a strategic sovereign asset, not just a reserve holding. It's this simple. Central banks are moving their gold out of London and New York to reduce geopolitical and access risks. India and France are among the biggest recent repatriators, with France now storing all its gold domestically. Geopolitical risks, we've got sanctions, fears over repatriation access, there's driving them to reduce their reliance on London and New York vaults. However, not factored into this, and other similar reports that are out there now, is that both the yuan and the ruble are 1-to-1 convertible to gold. And as we drew attention to in our February Live from the Vault liquidity provider report, In addition to silver and gold export controls, Russia and China are actively monetizing silver. Trade flow analysis backs up that Russia is monetizing physical silver as a reserve asset for trade settlement. In addition to the Russia Central Bank reported 500 tons of gold produced in 2025, Russia produces systematically 1,200 tons of silver per year. That's what they produce. None is exported. And we've been drawing attention to how the physically settled SGE physical gold and silver corridor has enabled this silver to be collateralized alongside gold as a high-quality liquid first-tier asset class, because it's in a physical environment. Alongside gold, this means that yuan silver and ruble silver is one-to-one backed with physical, consistently trading at a plus or minus 13% premium to London spot silver. All of this means the only central bank still short gold is in big trouble.
The pressure on gold is not presented as normal weakness, but as a battle between synthetic paper supply and unleveraged physical demand. Leveraged futures selling can still create fear on Western screens, especially around policy events, but those moves are increasingly being absorbed by Asian buyers and sovereign institutions. Shanghai premiums, central bank accumulation, and reported metal movements into China suggest that physical demand is quietly overwhelming the old pricing structure. The important signal is that paper selling no longer changes the larger direction as easily as it once did. If physical buyers keep using price raids to convert discounted contracts into real metal, then every manufactured pullback may reduce available supply and increase the risk of a short covering squeeze. In that environment, lower prices can become fuel for the next move higher in gold and silver over the cycle. Now, let's get back to the interview.
The COMEX gold futures market was launched by the Fed in 1974 for the sole purpose of containing the synthetically managing the price of gold. It was specifically designed to create enough freshly printed paper gold supply to dilute and benchmark a global foreign exchange price that no longer really reflected a genuine supply-demand price. Now, unequivocally, it was the Fed behind the rig chart painting overshoot of the targeted 200-day moving average. They were behind this. Yes, they incentivized the likes of these Jane Streets and these momentum traders, but literally, they were targeting that. It was deliberately designed to create the narrative that gold is no longer a safe haven asset. And as the leaked WikiLeaks memo outlined, and as we've experienced into every single bullish for gold news event over the last 60 years, always, soon as there's an event, huge swathes of counterintuitive 100-to-1 leveraged paper gold supply is instantaneously dumped into the futures markets to create the illusion that the dollar is a better hedge, better safe haven hedge than gold. And we've seen it for 60 years. And the Fed openly admits intervening in other foreign exchange markets in coordination with other central banks, as we've currently coordinated at the moment. We've got dollar-yen interventions. But because gold is the long or short side of a foreign exchange cross, inflating the dollar against the gold is really, it's intended to dissuade foreign central banks from swapping their unbacked dollars for US Treasury gold. It worked when there was no central bank competition, but now there is. And as this massive physically backed Shanghai futures market premiums have revealed, and we just looked at them, and when they are turned up, this time interventions are backfiring. And while this rigged official capping tool has been employed repeatedly over the years, the leverage to unleveraged paper to physical imbalance ultimately becomes so stretched it reaches an inflection point. We've once more reached the point where unleveraged commercial T+1 delivery obligations are overwhelming 100-to-1 paper supply. That takes a lot, and it marks the point where the house calls in the short bubble before Asia consumes its short cover. Now, after losing control of the synthetic price-setting COMEX tool, the unfactored black swan US-Iran war event Really what it did was enable the Fed to aggressively lean into this historical re-engagement of synthetic dollar, oil, bond yield, mechanical correlations, which, plus 100 days into the war-driven volatility, provided Western-facing traders the illusion that gold had lost its safe havens status. However, while this fake narrative has cleaned out every single rinsable paper long, alongside incentivizing a 100-to-1 bubble bet against gold, it has set up blue sky, physically driven run into all-time highs with no leverage longs on board. However, while bubble short momentums have provided officials with a degree of leverage short cover, for the last 19 months, the PPOC has openly been taking the long side, officially averaging 10 tons a month, as it once again reported by Bloomberg. At this rate of uptake, that's 85% of the 12 tons of Fed-borrowed BIS gold sales were officially bought by the PBOC. And liquidity providers assess that the June data will reveal substantially larger official Beijing accumulations, while much larger unreported monetary gold accumulations flowing into Beijing continue unabated. Also, the latest data for the unwrought non-monetary gold imports, and that is like doré bars, unrefined gold, it hit 86.7 tons in April alone, 81% higher than March. It's stepping up. They are grabbing everything in place, with June imports currently assessed at even higher record levels. Now, we're recording this episode just ahead of FOMC today, so we fully anticipate the synthetic actors. They'll be hunting out margin stops. I can see already, looking for little stops that might be upside, downside, so stuff they can rinse. So we fully anticipate them to do this, which they always do in a synthetic market. But we, along with all our Asian-facing liquidity providers, see this as just one more opportunity to convert underpriced paper gold and silver into physical. I mean, the only question left is to ask, how prepared are you for the next debasement leg of your fiat currency to unfold? I mean, central banks and sovereigns have openly stepped up, swapping depreciating dollar-related fiat for physical gold and silver.
The larger prediction is that the dollar-based system may be moving toward a gold revaluation event, whether openly admitted or forced by market pressure. The claim is that the old paper mechanism worked when central banks were not competing aggressively for physical metal. That environment has changed. Russia and China are monetizing gold and silver, trade settlement is shifting toward physical collateral, and global South demand is challenging the Western paper benchmark. If the Fed remains the only major central bank effectively defending the dollar against gold, its position becomes harder to maintain as physical inventories tighten. A failed attempt to suppress gold through paper selling could backfire if Asia continues taking delivery before short sellers can cover. The war-related stagflation backdrop only strengthens the case, because higher energy costs, weaker bonds, and currency pressure make gold more attractive as a sovereign hedge. Silver also becomes important if physical settlement corridors treat it as collateral besides gold. The final message is that the next debasement leg may arrive through a sudden shift in confidence, not a gradual announcement, leaving paper claims exposed and physical owners positioned for a major reset as the market starts valuing metal over promises again globally. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.